Good afternoon, and thank you for your precious time to join the Lunchtime Update with UOB Asset Management today. I'm Andrea Chan, the host for today. Throughout the webinar, you're welcome to join us in our discussion by posting your questions with the chat function on your screen, and we will pick some of the burning questions for our discussions. Today, we are delighted to invite Mr. Francis Ng to share the latest market development and investment opportunity after the rebound. Mr. Francis Ng, Chief Investment Officer, joined UOB Asset Management Malaysia in 2007. Francis has more than 23 years of investment experience encompassing equities, research, and fund management. Prior to joining UOB Asset Management, he was a senior analyst in a foreign securities firm and was a member of the equities research team ranked highly by Greenwich Associates and Asia Money. Francis is a CFA charter holder and holds a Bachelor of Economics by Macquarie University, Sydney, with a double major in Actuarial Studies and Finance. Please welcome Mr. Francis Ng for our today's session.
Thanks, Andrea. The topic of the presentation, I think for many investors, they have already seen markets rebound, and I think they want to know what can they look forward to in the next couple of quarters. So on the next page, you can see the performance of all markets year to date. So you can see that year to date May, most markets are still negative, but the declines I think have been less compared to previous months. So if you follow how the markets perform, March was the worst. April and May we started to recover. So when the markets first declined, we declined about 34% on average. So this is actually in line with the sort of market declines that we see in previous recessions. So and the decline this time is also quite similar to what we have experienced in previous recessions. And markets now have rebounded by about, they've gained back about 3/4 of the losses that they saw. What's different this time is that the rebound has been very sharp and in a very short period of time. And there are reasons for it, which we'll talk about later. But basically, we are seeing unprecedented government policy action. And that's the factor that has driven markets to rebound. So if you look at the presentation, we have divided into 3 sections. The first section will talk about things that we don't know, the unknowns. The second part, we will talk about the things that we know, the knowns. And the third part, we'll just touch briefly on certain funds, give you an update on what we are doing, what we plan to do going forward. So in the first section, if you look at the unknowns, we think that there are 2 that come to mind. And these unknowns, you could, I think at this point, we don't really have an answer, but we just have to monitor the developments in the next couple of months. So the first one is COVID-19. I think earlier on we thought that we got it under control. I think the last couple of days we have started to see cases climbing in certain countries, including the US. So this is something that we need to monitor. I think most people think that we are still in the first wave, it's just that the cases are climbing. I think in terms of a risk of a further shutdown in the economy, we think that that risk, as long as the cases are controlled, is probably quite limited for the moment. I think if you look at many governments in the world, they don't have the sort of political will to continue to shut down the economy. The US Treasury Secretary, Steve Mnuchin, has already come up to say that US can't shut down the economy again. And also I think the population having been locked, or many countries having been locked down for many weeks or months, I think many of them just want to get on with life. So this is something that we need to watch. I don't think any one of us has an answer how COVID is going to develop. But I think generally economies are probably better able to cope because having the experience from earlier on. So the second unknown is the path of the economic recovery. So I give you 2 sources here, and these 2 are very credible sources. So if you look at IMF, earlier on, they project that the GDP will contract by 3% in 2020. So they are looking for a recession, a 3% decline in 2020. But if you look at OECD's forecast, they are less optimistic. They are looking for 6% contraction in 2020. Yeah. And just overnight, IMF has further downgraded their numbers. So for GDP contraction in 2020, they are looking close to 5%. So you can see that the range of the forecast is actually very wide. Yeah. I think part of the reason is that we don't really know what to expect in the coming months. So we really need to see more concrete economic data over the next couple of months before we can have a better handle on how the economy is going to look like. Yeah. But generally, internally, we are looking for the economy to go back to 2019 levels sometime in either late 2021 or 2020, early 2022. So that's the kind of economic recovery path that we are looking at. Yeah, so in the meantime, we think that numbers will be quite soft. Yeah, so these are the two unknowns that I think investors need to bear in mind. So the next section will talk about the knowns, what we know. So what we know on the next slide is that governments are very, I think there is the will by a lot of governments to do whatever it takes to try to mitigate the impact of COVID-19. So we have seen unprecedented fiscal as well as monetary policy action taken by governments all over the world. So this table actually shows you all the fiscal stimulus that is undertaken by all the developed countries. So you can see it's just slightly over $7 trillion. This is equivalent to about 8% of the global GDP. I repeat, 8% of the global GDP. So if you remember the earlier slide when we showed you that at least IMF and OECD are projecting a 5 to 6% contraction in the economy in 2020. What it means is that when the worst of the effects of COVID-19 starts wearing off, we think that this fiscal stimulus that a lot of the governments are doing will be more than enough to actually counter the negative impact from COVID-19. Yeah? And this number is still rising. The latest number from IMF for fiscal is actually equivalent to about 11 trillion or about 12%, 11 to 12% of global GDP. So this number is rising. And we think that if these countries do not see the impact of the fiscal starting to show up in the economy, they will continue pump prime. Yeah? If you look at the US, I think recently they talk about another 1 trillion additional in terms of fiscal. So bottom line, the governments are quite committed to try to spend as much as they can. And in the case of the US, you are aware that there's a US presidential election this year. So it is in the president's interest to try to stimulate the economy to get it out of this COVID-19. So the other thing is on the monetary policy side, you can see that many governments have pursued very aggressive monetary policy. A lot of them have cut rates quite aggressively. And at the same time, I think some central banks like the US Federal Reserve, they have done something which they have not done before, which is unlimited quantitative easing. And this has started to show itself in the financial markets. You can see that many of the asset markets have started to recover. Yeah. So on the next page, I show you, I think one of the questions that we normally get asked is, people say that the economy is so lousy, all your earnings are contracting and all. Why are markets recovering so sharply? Markets can recover, and if you look at this table here, this table shows you the experience in previous market depressions. When markets start to climb, they can climb even in the face of negative earnings growth. So exactly what we are seeing now, earnings contraction, but markets can continue to climb simply because liquidity rules in the near term. And we have a flooding of liquidity from quantitative easing. Some of this fiscal spending will eventually get into the system as well. This again will liquefy markets as well. So you can see that on that table, basically, even on average, even with earnings declines, markets can climb. What they call the PE rating can actually continue to expand. So on the next page, we show you monetary policy. This is one of the main reasons why your asset markets are moving the way they are. And in the case of NASDAQ, it is already higher than what it started at the start of this year. So the US has done quantitative easing for the past many years. And what the lesson that we learned from quantitative easing is that when there has been quantitative easing, it has tended to be positive for returns for financial assets. Yeah, because it's a liquidity injection. It tends, one way or another, some of it will find its way into financial assets. And if you look at this chart, you can see the spike in the past few weeks. Right? The Fed balance sheet, I think now is about over trillion already. So you can see that they are really printing quite aggressively to counter the effects of COVID. And we think that this thing can continue. Yeah? So in the event that they need to do it, theoretically, there is no limit as to how much they can do. Yeah? They can continue to print quite aggressively if they want to. Okay, so that's on the what the central banks can do. Now, if you look at investor positioning, this chart shows you basically the money market funds as a percentage of total funds. And you can see that it is actually quite high. Yeah? So what this means is that we think should the market see some weakness, we think that some of this money can actually get back into the market and it will actually help to support the market. You can see that the money market funds, this is for both institutional as well as retail in the US, you can see that it's actually quite high as a proportion. Right? So some of this, we think that even if markets do correct, the correction may be quite shallow because rates are so low and investors are looking for alternatives to park their money. Right? So some of these, I think, is being parked in some of these money market funds, and they're probably looking for a better entry level. Yeah. So the new normal, a very often used term, I think one of the implications from this entire COVID thing is that rates are going to be very low for probably quite a long time. So if you look at the next page, this is actually very telling. Yeah. So this one actually shows you real bond yields. That means these are your nominal bond yields, and you take away inflation, right? So in real terms, what are the bonds yielding you? And actually, in many of the developed markets, we are seeing a high proportion, almost 60 to 80% of it is actually in negative real yield. So if you park money in fixed income, especially if you park money in government bonds, you are prepared to take negative real yields. And because we are in an environment where rates are so low, I think people are looking for alternatives, which is why you are also seeing this strong rebound that we've seen in equity markets. So on the next page, in terms of government policy, closer to home, if you look at Asia, we think that Asia actually has more bullets if you compare to the developed markets. Asian governments generally have lower public indebtedness compared to many developed markets. So if you have lower public debt, it means that you can continue to pursue quite aggressive fiscal pump priming if you want to. The other thing is that if you look at the interest rates in Asia, is generally higher than developed markets. So it means that from a monetary policy standpoint, many of the governments actually can continue to cut rates if they choose to. And no Asia ex-Japan country has actually even undertaken QE. When you compare to many developed markets, a lot of them, or many of the major markets have actually done QE already. So the point here is that Asia, including ASEAN, I think has quite a lot of, we still have quite a lot of policy options to exercise should we choose to. Yeah. So if you look at where markets are now, we think that you can still get positive returns from equities, But given that equities have rebounded quite strongly, we are more neutral on equities at this point in time. We are overweight fixed income. We think that fixed income, especially in the investment grade space, still offers quite good risk-adjusted returns. So within equities, we think that there's probably a space for some investors to look at more defensive type options or more defensive type markets. So you can still benefit if equity markets continue to rise, and you also take care of your downside, as in in the event that we do get any drawdowns, you probably your defensive market will probably be less volatile. So the two defensive options that I'm going to talk about is actually ASEAN as well as Malaysia. So if we move to the next page, so ASEAN here, you can see in terms of, this is like a volatility index. The red bar is ASEAN. So you can see that ASEAN, it's got some defensive characteristics if you compare to many other markets. So it is, we think in this kind of environment, and given ASEAN has not really done that much, it's actually quite a good option in terms of if you balance out your risk returns. What ASEAN has going for it on the next page is actually on the foreign direct investments side. So if you look at the investments coming to ASEAN, ASEAN has already surpassed China as a recipient of FDI. Yeah? So ASEAN continues to attract a lot of FDIs, a lot of investments, and many of our stock market investments are actually in companies that we think will benefit from this. Yeah? And part of the reason why ASEAN is benefiting from this is, we have a good labor pool, relatively inexpensive, pro-business governments who want to attract investments. And the other thing is, of course, the trade tensions that are going on around the world. And we think that this trade tension is not just a 1 quarter thing or 2 quarter thing. We think it will continue to be relevant in the years to come. Especially once I think the US presidential elections are over, we would not be surprised to see the trade tensions rising. Yeah, so if you look at the next page, it is not surprising that ASEAN is actually a beneficiary of trade diversion. Yeah. So if you look at the royal blue part, so that's the sort of so when JP Morgan did this survey, and a lot of the companies that they surveyed actually are considering Southeast Asia as a manufacturing hub if they need to make any supply chain adjustments. So ASEAN, we think, will be a beneficiary, and we think that this will be this is not just a 1 or 2 quarter thing. We think that this is going to be structural. And the other thing I think which is not highlighted very much is actually the potential in e-commerce. I think we are all quite familiar with the e-commerce scene in China. China is huge, and ASEAN, we are just we are just at the, I think we still have a long way to go in terms of e-commerce penetration. Just to give you a sense, right? I think every one of us know Grab. Right? I think we use their services, whether it be for food delivery or for transportation, etc. Right? So Grab is what they call decacorn. Yeah? For those of you who are not familiar, an internet startup that reaches a valuation of $1 billion is called a unicorn. A decacorn is when your market value reaches $10 billion. And recently, we just had another decacorn in ASEAN. It's Gojek. Yeah? Gojek, the Indonesian ride-sharing company, and I think they're also branching out into other things, pretty much like Grab. So this is a space which we think there will be more and more developments in ASEAN, and I think in the years to come, there will be more investment opportunities opening up for us to play ASEAN e-commerce. Yeah. So that's on ASEAN. I'll move on to Malaysia. So Malaysia, like other governments, we have the government here has responded to the impact of COVID. So far, all the fiscal policies that we have announced, the injection by the government is going to be about 45 billion. It will take up our fiscal deficit to about 6%, which we think is quite manageable. I think initially we were a bit fearful because oil price dropped quite sharply. I think the recent rebound, I think, is quite good for Malaysia. I think it's going to help us, and I think it will probably open a bit more options to the government in terms of fiscal spending. And the other phenomenon, which is quite recent in Malaysia, on the next page, the retail investors are coming back. Why are they coming back? One of the reasons we think is on this page. So besides fiscal, the government has also responded in terms of monetary policy. They have cut the OPR all the way down to 2%. Arising from that, you know that fixed deposit rates are now down quite a bit. So compared to a few months ago, when some retail investors can probably get fixed deposit rates at close to 4% when there are promotions, now I think the rates are down to about 2% if you put in for a year, around 2%. So at around 2%, I think for some of these investors, they are looking for options because 2% may not be attractive enough for them. And I think that's one of the reasons why the retail investors have come back. So if you look at the next page, if you look at retail participation, on certain days in the last couple of weeks, retail participation can be about 35 to 40% of the trading value on Bursa. This is much higher than the 20% average that we saw maybe 1 to 2 years ago. Yeah. So we can see that despite net foreign selling, the retail participation has definitely helped to counter some of this net foreign selling. And even the net foreign selling in Malaysia is not that aggressive because the foreign investor holdings in Malaysia is actually quite at multi-year lows. Yeah, so unlike other markets where the foreign selling may have been more aggressive, I think in Malaysia it has been a bit more muted. Yeah. So we think that because rates in Malaysia will probably stay low for a while, we think that the interest by the retail investors, we think will continue to be there. Yeah. So that's the conclusion for the Malaysia portion. I mean, just to wrap up the market views, I think number one, we think that because markets have rebounded, we have a more neutral view on equities. But we think that equities can still continue to give returns, although it will not be as aggressive as what we have seen in the last 2 months. We think that the returns will be supported by unprecedented policy action by governments, as well as cash positioning. There's still a lot of cash on the sidelines which can find its way into equity markets. Yeah? So we are more positive on fixed income. We are overweight, especially on investment grade. We think that some of the risks that you should monitor is COVID-19, the path of the economic recovery, as well as any tension, any flare-up in trade tensions. So against this backdrop, the sectors that we tend to like, we like global leaders. We think that this pandemic, a lot of the global leaders will actually benefit, as in they will emerge from this crisis even stronger compared to their competitors. Yeah? And many of the leaders that we like tend to be in the technology space. We quite like technology because technology gives you, can continue to give growth in an environment where you are probably quite starved of growth. So we think things like tech and healthcare can continue to deliver some growth. And then we have some defensive sectors like utilities and telecoms, companies where the demand is relatively more resilient, and we think that will be less affected by this economic downturn that we expect to see over the next quarter or so. So as an option, I think investors should consider looking at some defensive options like ASEAN. We think that ASEAN will be a beneficiary of trade tensions, and we think that this thing will be structural. It will be around for the next couple of years. For Malaysia is also quite defensive, and I can share with you, Malaysia, if you get your stock selection right, you can actually get very decent returns, although the market return may not be that hot. So that's the conclusion of the market update. I'll just talk briefly about a couple of funds. I'll talk about 3 funds here. One is United Income Plus. Second one, I'll talk about United ASEAN Discovery in light of some of the comments I made earlier about ASEAN. And then I'll also talk about United Malaysia Fund. This is a Malaysia mixed asset. We can do both equities and fixed income, although now we are predominantly in equities. Yeah? So for all 3 funds, we have recovered already. All 3 funds are now positive on a year-to-date basis. Yeah? All positive on a year-to-date basis. Yeah? So I'll start off with United Income Plus Fund. This is the more conservative one. In the month of May, I think we continue to track well ahead of the benchmark. If you look at the top contributors in terms of performance, I think the rebound, the continued strength in the US market definitely helped us. We have this fund has quite a heavy positioning in the US, and I think some of the selected Malaysian stocks that we bought, some of the leaders like Top Glove, I think the gloves had a very good run, and Pentamaster I think continues to deliver fairly strong growth in terms of the earnings as well as the share price. So if you look on the next page, the strategy here remains the same. We are going to be very focused. A lot of the core of the equity holdings here are going to be global market leaders. In terms of the fixed income side, we are predominantly in Malaysia. We have a little bit of exposure in Asia and emerging markets to give us a bit of a yield pickup. You know that in this environment, yield is actually quite low. So our average yield to maturity, we have slightly over 4% at this point in time. Yeah? So we think we have quite a good balance between yield as well as growth here. Yeah? So if you look at the top 5 holdings, you will see many US names there. Okay. Then I will just move on to United ASEAN Discovery. This one, the performance in May was much stronger. It is a pure equity fund, and many of the stock selection here, I think, delivered very, very strong returns. Yeah? So if you look at the fund, it rose more than 20% just in the month of May, much higher than what the underlying market was. The underlying market only rose about 6%, which in itself is actually quite strong. The benchmark is absolute return, so we were ahead of the absolute benchmark by some distance. And if you look at the top contributors to the performance, it's actually the healthcare names as well as the tech. These are the 2 sectors you will find across board. We are quite we are overweight in. Yeah. So on the next page, we were also helped because when the markets fell, we actually added some stocks, and we caught the rebound quite nicely. Yeah. So for ASEAN Discovery, given that some of the economies have started to reopen, we are adding very selectively some domestic-centric companies. So some of these domestic-centric companies, some of them can be involved in property, can be involved in retail, can be involved in autos. So we are looking at some of these because the share price has come down. And as we reopen, we think that the sentiment on some of these stocks we think improve. Yeah, but it is very selective. We only want quality names in here. Okay, and then just finally on the United Malaysia Fund, like I said, Malaysia, if you look at the index here today, nothing great. Yeah, to be honest, right? But if you look at the fund performance, I think we are well ahead of the underlying market. Just in the month of May, we are up 20%, quite similar to United ASEAN Discovery. Top contributors again, it's the healthcare and tech which are delivering very strong returns for the fund. So if you look at the next page, exposure here, I mean, we kept our investment level quite high because we think that Malaysia generally quite defensive. So even in the down market, we think that it will hold up relatively better, and that on the rebound is actually done quite well. So for Malaysia specifically, we are positioned. The positioning is still quite narrow. We are looking at healthcare, technology, utilities. We are starting to look at some of the domestic centric, but very selectively. I think there are not a lot of very clear bargains for us to look at this point in time. But we are looking very, very hard. So actually this concludes the presentation. I'll be happy to take any questions.
Thank you, Francis, for the insightful session. So before that, I would like to congratulations for the United Income Plus in winning the Refinitiv Lipper Funds Awards Best Mixed Asset and Conservative in the 3-year category awards. So as a reminder, audience are welcome to join in our discussion by posting your questions on the chat functions on your screen. So while we are waiting for the questions, maybe I'll start with some questions. So Francis, there's 3 questions over here I would like to ask you. First question is, the quick response from global policymakers has been supported the market well from sell down earlier on. Do you expect more to come, particularly in ASEAN or Malaysia? What is the implications of such to United Income Plus strategy and its income distributions with easing tone carry on?
Okay, so in terms of government policy, we think that it can continue. Not only I think globally it can continue. The numbers keep getting bigger and bigger, right? The earlier slide I showed you, we started fiscal stimulus at about 7 trillion, now we are at 11 trillion. And if you look at within Asia, I think I shared the chart with you that Asia we think we have more bullets compared to developed markets, right? Because governments say have less debt, so we can pursue more fiscal. Interest rates are higher, so we have room to cut rates if we want to. And we haven't even done QE, so we think that Asia has options. So in terms of implications for United Income Plus,
Yeah, United Income Plus strategy.
Okay, so for United Income Plus, the distribution, one of the key things that we look for is distribution. This is something that I think that the investors are looking quite closely. Now, so if you look at the blended underlying yield for Income Plus, it's about slightly over 3%. Yeah, and we aim to pay quarterly. Yeah, so every quarter we target to pay a minimum of around 0.75%. Yeah, so with underlying yield of about 3%, your 0.75 at least, the minimum that we're trying to target should be relatively secure, right? And what we normally do in the month of July, which is the month end or the financial year end of the fund, in the month of July, we will look at the fund, what we have realized in terms of gains, in terms of all that, and we normally try to pay a bit more. So we think that the 3% is there, and considering that FD is only giving you 2%, we think that 3% is actually very decent, and it could be higher depending on the capital gains that we get especially from the equities. We have some equity gains, so we should be. July is only another 2 months. 2 months, so we should have an idea how much we can declare.
That's really a pretty decent yield. So the next questions will be Malaysia market has done relatively well against other ASEAN countries on year-to-date basis. What has contributed to the outperform and how has United Malaysia Fund positioned earlier and moving forward?
Okay, so if you look at the performance of Malaysia relative to other markets, you will see that Malaysia has, traditionally been a defensive market. Right? So in a period where all your markets are declining, if Malaysia is living up true to its defensive characteristics, it will fall less compared to other markets. So that's one of the reasons why. I think the other reason is that if you look at foreign ownership, because some of the market declines are caused by foreign investors selling, right? They want to, they want to sell out of this region and move it elsewhere. So because Malaysia's foreign shareholding is actually quite low, right? So they have less of us to sell, and so the selling pressure is not as intense for Malaysia, and that again has helped to cushion some of the market decline for Malaysia. So for the United Malaysia Fund in particular, we were very clear coming into this COVID crisis. We think that you cannot just buy everything. You cannot just buy across board, because there are certain sectors that will get hit more compared to others, right? So we took the conscious decision to buy or to position heavily in sectors which we think will be relatively less hit or could even do well in this kind of COVID environment. So you can see that the focus is actually quite narrow. We look at the defensive, so like telecoms and utilities. Utilities are things like tenaga, right? So for growth, we look at healthcare as well as tech. And these stocks, these companies generally, they have done much better in this environment. And it's reflected in the stock price as well. The stock prices have also appreciated, and the fund has certainly benefited.
So the next questions will be like US-China tension resurfaced recently, and many saying that ASEANs are potentially beneficiary as manufacturing names moving down to Southeast Asia. What is the implications to the ASEAN outlook and our ASEAN Discovery Fund positioning?
Yeah, so I touched on a bit on this in the market presentation. So we think that this trade tension, we think, will be a continuing trend, right? I think recently we have seen some noises, but by and large, I think our view is that they may not want to stir up too much trade issues now, because you're coming into a presidential election, and the economy is still a bit fragile. But we think that once we get past the presidential elections, the trade tensions could worsen. Now, so in an environment where you have trade tensions, I think we are already seeing many of these companies trying to diversify their manufacturing base. So if previously if you were thinking of expanding in China, maybe you think, I want to manage my risk a bit, diversify, and you can see that I already told you that ASEAN has already surpassed China as a investment destination. We think that this will continue. We think that ASEAN is extremely competitive, and the way the fund, the United ASEAN Discovery Fund specifically benefits from this is we have invested quite a bit in some of these manufacturing companies as well as some of these tech-related companies, and they have definitely, or some of them have benefited from trade diversion. So instead, some business which they previously would not have gotten, I think they're getting it now, right? And some of them, the inquiries have also increased. Some of these could translate into business further down the road. And if you think that more and more investments are going to be set up here, right, this will help your longer term.
That's why I would say diversification is very important. So I have a few questions from the audience. So the first question is, what is your comment or view on the article "Stock Market Bubble Burst is Possible on KLCI," says MIDF research that appeared on The Edge today?
Okay, I think everybody is entitled to their opinion. Okay, I think you have to take a few things into account. Okay, the few questions you have to answer is number one. Do you think that the economy will recover back to what it was pre-COVID? I think it will, right? It's just a matter of time. Whether it be 1 year or 2 years, I think we will get there because government policy has been so aggressive, right? Now, so if you think that the economy will get back to where we were, our previous peak, right? Eventually, the stock market has to reflect that as well, right? So, if the economy recovers back, you would think that the stock market will also have to recover back. And we are now still below what we were, right? And we think that it won't just recover, we think that earnings will continue to grow. It may not grow, it's still very early days, it may not grow as fast as what people may think, but it will still continue to grow, right? That's one, yeah? We think that a bubble, I would not agree with it. Number two, if you say a bubble relative to what, right? If your interest rates or your risk-free rate is going to be so low, everything is priced off against this, right? Your simple investment knowledge will tell you, if your rates are low, you're going to discount things at this low rate. And when you discount these things at this low rate, you're going to be able to justify a much higher valuation, right? So, is it a bubble? Is, relative to 2% that I get on fixed deposit, it's not a bubble, right? If I can still get decent returns, yeah? So I think, I think the market has rebounded quite sharply. So I think some amount of caution is warranted, but I don't think it's bubble territory.
Okay, so government and corporate bonds are fixed returns asset. Can you explain how bonds can have negative yield?
Oh, okay. This is not okay. What we are talking about is not negative yield. We are talking about negative real yield. Yeah. So that means, let's say if the bond yield is, let's say, 1%, right? But your inflation rate is if your inflation rate is 2%, for example, right? So in real terms, your return is actually minus 1%. You are getting, through your bond, you're getting 1% return, right? But in real terms, in actual purchasing power, you are actually worse off, right? Because now your $100 can buy less goods, right? Because of inflation. And so you have negative real yield, not nominal. Nominal, mostly still positive, although you have some markets where you are getting negative, not even nominal yields.
So don't get confused with the negative yield and negative real yield.
Yes. One is nominal, one is real. Yeah.
I see. So, questions on United Malaysia Fund. The fund investment strategy investments are from bottom up small to mid cap stocks and holding cash waiting opportunity. But why benchmark is 50% KLCI and 50% short medium MGS index?
Okay. Why? Okay, maybe I answer the second part first. The reason why when we developed the product, we developed it as a mixed asset because we want the flexibility. Sometimes the equity market may not be so good, right? So you want the flexibility to shift into fixed income, right? To protect your returns and all, right? So we want this kind of flexibility where we can swing, right? So, and if the strategy is to be able to swing, then you would we settle on a midway where it's 50% fixed income benchmark as well as a 50% equity benchmark. So that's why the benchmark is like this. Okay. Now, why are we positioned a lot more in equities? There are actually two main reasons. One is we think equity will give us more juice. We think equity can give us better returns. That's one. I think the other thing also, we are in a way the bond option is not really an option, because bonds minimum is 5 million per lot, right? And this fund size is actually quite small, so bonds are not an option at this point in time. So our choice is actually to be parked in equities or to park in cash, right? And we think that we think that on balance, equities we think will give better returns versus cash. Yeah. So the strategy, you're right, is very much stock picking. It's very much bottom up. I wouldn't say it's small mid cap. Many of the growth stocks are actually large cap stocks, or many of the other stocks are also quite large cap. We do not have a fixed number when we think of whether we want how much in small mid cap or how much in large cap and all that. I think the whether it is small or whether it's mid or whether it's large is just coincidental. We go to where we think the opportunities are with our bottom-up research. We look for companies which we think over the long term can give us decent returns, and we buy those type of companies. So we are agnostic. I don't have a preference of small, mid over large or over what to paraphrase, we don't care whether the cap is black or white. We just want the cat to catch the mice.
So it's like, to recap, EMF is more to bottom-up approach, and the fund manager will not select, they do not have a fixed percentage on small or mid or to large cap. So as long as there's a potential on the stocks, fund manager will go into it.
Yes.
Yeah. So like
subject to diversification, of course. We cannot have just one sector.
Yeah, exactly.
We try to have adequate diversification.
Yeah. So it's like, okay, many retail investors see the current market fall and rebound as quick way to make some money. Can this sustain the markets into the quarter 2020 and next year?
Okay, that's a very interesting question, right? So the perception of retail money is that it is hot money. Yeah. So they may go in and out quite fast. This time round, I think the one difference that you have to take into account is that for once in a long time, your FD rate is actually quite low. Yeah, FD rate, if you park 1 month, is only 1.something%. If you park 1 year, you get about around 2%. If I just look very simplistically, the dividend yield on the Malaysian market is already 3%. Let's say you don't believe the yield, you think some of the companies will cut their dividend. Even if they cut, I think you still get 3s, maybe even high 2s, right? Which is your yield on the underlying market is already better off than your fixed deposit returns, right? And we think that if you get your companies right, you can probably get capital appreciation as well over the long. So we think that the retail money, I think there will be some in and out. But I think you need to bear in mind there are a lot of fixed deposits in the Malaysian banking system. Rates are extremely low, and we don't think that it will go up anytime soon. In fact, I think there is an option for Bank Negara to even continue to cut rates, right? And if you look at the relative kind of valuation that I shared with you, FD rate 2%, 1 year, dividend yield, excluding any capital appreciation, dividend yield on your Malaysian market, we think it's already around 3-ish type %. Yeah. So this thing hasn't happened in a long time. It's always the deposit rates that do better than Malaysian dividend yield. So now this is reversed. So I think some things have changed, and and they have had good experience, right? They bought this time round and they made good money on it. So hopefully, human nature, if you have good experience, we keep wanting to get more.
Okay, so like for Malaysia market currently are supported by retail investor. So what's your view on the second wave? Will this impact the funds?
Okay, I think if we do get a second wave, I think there will be some negative impact on the market. I think but we think that the dips may not we think could be quite shallow. I think number one, governments are better prepared to handle any further infections. I'm assuming that it doesn't blow up in a big way. Second thing is that government policy action, we think they continue to have options. They can continue to do anything on fiscal, anything on monetary, right? So these things. And then I think I shared with you earlier that if you look at the money market funds, it's not just fixed deposit. If you look at money market funds, there's a lot of money on the sidelines, right? And if you look at the ratio, it's actually quite high relative to what it has been historically. So we think that if the market falls down too much, we think some of this money can go into the equity market,
okay.
or even the fixed income market.
Okay. There's one question on ASEAN Discovery Fund. So the fund has underperformed the benchmark, which set at 8% per annum since launch. What are the strategies to overcome underperformance? The fund is focused in small to mid-cap equity, but heavily in Malaysia and Singapore, but other ASEAN like Indonesia, Philippines, Cambodia, and Thailand.
Okay, number one, I think I need to if you look at the fund since inception, we are actually the annualized return is above 8%. Yeah, you have to bear in mind that the underlying market is a lot lower. It's nowhere near 8%. Nowhere near. Yeah. So the fact that we are able to even track the 8% absolute return, I think is already quite a feat. Okay, that's one. Number two, there is a reason why we are heavier in Malaysia as well as Singapore recently. Yeah. Now, so if you look at the performance of all the ASEAN markets, right, Malaysia has actually fallen the least, right? So in a way, there is a reason why we position the Malaysian market, because we think that it's going to be relatively more defensive. The other markets we think will fall more. Yeah, so it was right for us to position more in Malaysia. And Malaysia had the opportunities that we were looking for. We were looking for opportunities in healthcare. Malaysia is the center of the universe for gloves. Okay, for glove manufacturers, Malaysia is the largest producer in the world for medical examination gloves. Right? So a lot of the opportunities that we were looking for were actually in Malaysia. Again, that's why we don't choose Malaysia deliberately. We just look for where we think the opportunities are. We also like tech, right? Tech, a lot of the electrical as well as electronic manufacturing services company. Again, Malaysia has quite a lot of options, and a lot of our companies here are benefiting, we think, from trade diversion. So that's why we have a bit more in Malaysia. Recently, we have positioned quite a bit more in Singapore, because a lot of the REITs, REIT prices fell quite sharply. So we saw the opportunity there. We are prepared to take a longer term view on it, and we think that the REITs will come back. Many of these REITs were sold down very heavily. So we use that as an opportunity to increase our position. Hence, that's why you see some of the Singapore rating has gone up. Yeah. So it's not that, like I said, we are bottom up, so we look to where we think the opportunities are. So if you look going forward, in the next maybe 2 to 3 quarters, what we see is that as long as COVID we are able to keep COVID-19 under control, then the domestic centric sectors will start to look interesting again. Right? And we are already looking at some of the Indonesian stocks quite closely, because we think that when the domestic centric theme comes in, we think that market like Indonesia, like Philippines, those will do may do quite well. So we are already looking at opportunities there. We just think that it is probably still a bit too early to pull the trigger on some of these domestic centric names. We have a bit, but not a lot yet.
Okay. So I think that's it for the Q&A sessions. Thank you for the overwhelming questions. If any of your questions is not being answered, you can just PM our marketing representative, and our marketing representative will follow up on your questions. So before we call it a day, any last piece to the audience?
Markets have rebounded. I think you are right to maybe be a bit cautious, and you should be a bit cautious. Right? I think you just have to bear in mind that government policy can be very powerful. You just look at this market rebound. The government policy has had a very big impact on the rebound. And if you look at, we think that as an option, you can consider some defensive market options, so you can still get the upside from the if markets rise, and on the downside, it will help to you. If you look at more defensive markets, they will be less volatile on the downside as well. Yeah, that's what I would say.
So thank you, Francis, for the insightful sessions. Thank you for attending the webinar sessions. That's become the end of the sessions. So hope you'll enjoy these insightful sessions from Francis. So everyone, stay safe and stay healthy. Thank you very much.
Thank you.